Here's the Hearst analysis on bonds. This is an analysis going back to 1980. So this particular Hearst analysis is able to see and label that low in bonds that occurred back, I believe it was in 82, 81 maybe, where interest rates were extremely high. They're the highest any of us have ever seen. I remember mortgages at the time reached, up 30-year fixed mortgage up around high teens, in the high teens. And it seems impossible now. But that's when Volcker was Fed chair, and he was bound and determined to crush inflation and kept raising interest rates and managed to do it. And bonds have been moving up in a huge cycle ever since. Ever since that low in 81, 82. So this analysis only has two repins in it. And one of them is the most recent high. And I looked at this 9 ways to Sunday, and I think those are good repins. But notice that this move down that we've seen, this kind of breakdown out of that caterpillar pattern, almost every Elliottian thinks that that's got downside continuation to it in a huge way. And if that occurred, we would have bonds lower and yields higher, mortgages higher. All of this extra debt, the trillions upon trillions that where the government has printed money and loaned it to itself by buying bonds, that would cost, if bonds continued lower and yields higher, then the Fed or the government would not be able to afford to pay its interest obligations, and it would be almost certainly, if we've seen a major trend change, the downside of a default. So I think we're at a critical juncture. The interesting thing is, Japan and Europe have been a negative yields, negative interest rates for quite some period of time. The U.S. has been saying, no, we don't want to go there. Of course, they don't want to go there. But, I don't think they're going to have any choice. And notice this 80 or 18-month cycle trough, very tidy right here. And there's no trough repins here that would suggest that yields are going to stop going down here now and it's going to move up. And there's a huge cycle peak nest up here toward the end of the year and maybe into the first quarter of next year. So I think that this move to the downside in bonds may reverse right now. And so here's the way I think that would roll from an Elliott wave standpoint, and that is that this is a TLT, that after a 5-wave up structure for from the low in November of 2018, we got a very quick flash wave B, and now bonds are going to work their way higher. So notice I've been calling for a pullback in stocks down into July. So I think the bonds works its way higher into July. Next, I think we get a surprise reversal on bonds, and that reversal will act as a safe haven reversal while stock market rolls over and moves down into July, August. Then the stock market will move up into the election, and while that happens, it's risk on, and so bonds move down into, guess what, the election. Then that's the top of the stock market. Stock market rolls over and starts hitting down more aggressively, and that's where we see this higher move in bonds. Eventually, and actually by the time we get to maybe February of next year, could easily see negative interest rates from the U.S. So right at the moment, I think we're going to see a pullback in stocks, and we'll see some jumping over out of stocks into bonds into July. So that is one way that I have applied what we just saw. So this roadmap, that's one way that I've applied this Hurst roadmap into an Elliott wave count. But I've got other ways to do that as well. Almost all of them have bonds topping early next year. Now, on the CB contract, maybe as late as May. As we move in a little closer, maybe what we're getting, maybe wave B didn't end here on that plunge down into March, and maybe what we're getting here now is a triangle, and we've gotten an A of the triangle and a B of the triangle, and now a C of the triangle, and now we're going to move to the upside in D of the triangle. Now, this is a I'd used an earlier roadmap from a different item on where these months come in, but I think it's much more likely that this moves up through, I'm going to say, we'll say August, as we get a little bit of risk off. And then the stock market puts its final high end for the year there in probably late October, early November. And then stock market starts getting hammered, and you see a bunch of flight to safety into bonds at that time. So this is another way to look at it. The DSI just recently got down to a 27 on bonds. That's certainly low enough to get a bounce, especially if we're in a triangle. And even though the commercials as a percent of open interest have been looking to the downside in bonds, it's like all of a sudden they're not so sure. And these 6-month look back commercials on bonds are really just back at neutral, where they could bounce. So on the ZN contract, I think I've got another way to look at this on the ZN contract. I'll notice the projection of a top maybe in May. Could be earlier than that, maybe in May of next year. And this is an expanding ending diagonal, in which case we would need an A, B, C to finish the move in bonds. And that puke down into March maybe was just wave A, and now we get an expanded flat up into July for wave B, and then the move down in bonds into the election, then much higher. So there's another roadmap that projects that we could easily stop going down right here in bonds and start moving up in a safe haven move. It would require that the stock market roll over, probably. And notice that lately the bonds, which is the black line, and the US dollar, the green line, have been moving to the downside. And so has gold. And this would allow for possibly a bounce in all three. And so we'll have to get, the only question in my mind is gold, is whether it's going to bounce here or not, because silver and platinum, I think, continue to be bearish generally into August. Well, so we'll see how that turns out once we get to the metals. But I think we're going to get a surprise rebound in bonds starting about any minute and moving up into late July, something like that.